Good afternoon and welcome to Bulls, Bears, and the Bell. Thank you for joining us. Today we are diving deep, really deep, into what feels like a very complex market moment. It's Monday, November 10th, and we're seeing this intersection of, well, pretty radical political relief on one hand and some profound economic uncertainty on the other.
Yeah, I mean, if you just glance at the headlines, the major indices, it looks like a powerful rebound, right? A real risk-on surge. Everything's green. It suggests maybe all the fear from last week just evaporated. But if you look closer, here beneath that surface, especially at individual stocks, you find this really deep, almost schizophrenic contradiction.
That's a good way to put it, schizophrenic,
Yeah.
because the market seems to be celebrating this potential end to the government shutdown, this macro euphoria. But at the same time, it's absolutely savage towards any company that even hints at a future growth slowdown. It's a strange mix.
So what's driving it if it's not pure economics? Well, what's crucial to understand today is that the main driver, the volatility source and the relief we're seeing now, it's almost entirely political and technical. It's not really about fundamental economics changing overnight. The market's been held hostage, really, by this potential end to the, record-setting 41-day U.S. government shutdown.
41 days, yeah.
And that shutdown created this genuine data vacuum. We'll get into the details. But this vacuum, it's essentially blinding the Federal Reserve. And it's forcing investors, forcing you to make huge capital decisions pretty much in the dark.
Okay, so let's try and unpack this market structure. We need a plan. Our mission today, our deep dive, that's sort of a three-part journey. First, we have to dissect this sharp risk-on rebound. What's the political catalyst? Why today? Then we'll zoom right in, down to the micro level. Look at these extreme, sometimes almost illogical punishments or rewards for specific stocks, like what is going on in the growth sector. And finally, we have to look ahead at the frankly daunting macro reality. How do investors navigate a week where the most critical economic data, CPI retail sales, is just missing? And how are corporate earnings suddenly the only game in town? All right, let's start with the immediate driver. That kind of all-clear signal the markets seem to get late Sunday. After 41, frankly, agonizing days for many, the dominant story this morning is just palpable optimism, isn't it? About ending this record shutdown. We sort of moved from just hoping to seeing actual procedural progress.
That's the absolute key distinction. Markets don't really trade on vague hope for long. They need action. And the catalyst was the U.S. Senate advancing a key procedural measure late yesterday. Now, investors are interpreting this, rightly I think, as the first concrete bipartisan step toward a resolution, something that could actually reopen the government, maybe even this week. It signals that political logjam, which was the biggest source of non-economic uncertainty, it might finally be breaking.
And the crucial detail there, you mentioned bipartisan, was the vote count, right? Because that tells us if this compromise might actually stick. This wasn't just, ticking a box along party lines.
Exactly. The measure got the 60 votes it needed. And critically, reports say 8 Democratic senators joined Republicans. That willingness to cross the aisle, that's what signals a genuine, viable path forward, maybe an irresistible one to finally end this thing.
Okay, so connecting that political spark to the market action today. This rally is essentially just unwinding all that fear that built up last week.
Purely. It's an unwinding of the fear premium. Last week was characterized by really severe, almost structural losses, and they were driven by these twin anxieties we talked about.
And we really need to stress how bad that damage was before today's bounce. It wasn't just a little pullback. The NASDAQ composite, the tech-heavy one, fell a brutal 3%. That was its worst week in 7 months.
Yeah, the worst since those Liberation Day tariff headlines were flying around. A long time ago.
Exactly. And the S&P 500 lost 1.6%. The Dow dropped 1.2%. This felt like panic selling, driven by uncertainty.
And fueled by those two specific fears. First, the shutdown itself dragging on, delaying data, that's the data vacuum anxiety. And second, which is maybe more structural, these mounting and frankly legitimate concerns about lofty, maybe inflated valuations, especially in AI and the broader tech sector. So traders were kind of using the shutdown as an excuse maybe to aggressively take profits on stocks they already thought were too expensive.
Okay, so here's where the character of today's rally gets really interesting, doesn't it? Because which index is leading tells us which fears are unwinding the fastest. The fact that the NASDAQ 100, super tech-heavy, is leading the charge. Futures were up 1.0% to 1.5% earlier, maybe more on specific contracts?
Yeah, the NQZ25 contract was up over 2% at one point.
Right. That confirms the money is pouring right back into the growth sector, the very place that was the epicenter of last week's panic.
That's behavioral finance 101 right there, isn't it? It's risk capital returning. When fear recedes, even temporarily, money tends to flow back into the highest beta assets first. And right now, the Nasdaq, tied to that AI narrative, is the highest beta game in town. You see the S&P 500 futures up robustly, 0.6% to 1.0%. But look at the Dow futures lagging quite a bit, only up maybe 0.2% to 0.4%. That difference really underscores that this is fundamentally a technical unwinding of that valuation fear, kicked off by political relief. It's not really a sudden shift in the economic outlook itself.
And it's not just a U.S. story either, is it? This optimism seems global.
Absolutely. Broad-based confirmation of a sentiment shift. Shares surged in Asia overnight. Europe is strong. You mentioned the German DAX, France's CAC 40, both up over 1.4%. Big moves.
So risk is definitely on. How can we confirm that rotation, say, away from safety?
Well, look at the traditional safe havens. Money is actively leaving safety, or at least pausing its inflow. We saw the yield on the benchmark 10-year Treasury note tick a bit higher to around 4.11%.
Okay.
Which means bond prices dipped slightly as investors felt less need for that government bond safety. Capital's rotating.
And the VIX? The fear gauge?
Dropping like a stone. The S&P 500 VIX declined sharply, nearly 7%, down towards 18.5. That signals traders are much less willing to pay up for portfolio protection for puts. The immediate fear is subsiding.
Even gold.
Even gold, which often acts as that hedge against systemic uncertainty, it rose nearly 3% earlier to $4,120 an ounce. The whole complex is saying, uncertainty is receding, let's put risk back on the table, for now.
Okay, so that's the big picture, the macro euphoria backdrop. But now we have to zoom right in. Because while the indices are flashing green, the micro landscape, individual stocks, it's defined by this intense, almost irrational scrutiny. It's like celebrating in the streets while auditing every single house line by line. Let's start with M&A. There's this interesting premium paradox playing out. Okay, first case. Treehouse Foods, ticker THS. Shares are just soaring today, up over 21%. The story seems clear. They're being bought by a European private equity firm, Invest Industrial. Cash deal. $2.9 billion, works out to $22.50 a share, plus this thing called a CVR.
Right, a contingent value, right? But the paradox here is, frankly, stunning. And it's a crucial lesson for listeners in how takeover valuations can operate completely independently of current operational performance, because this pretty generous acquisition premium completely, utterly overshadowed what was genuinely a disastrous third-quarter earnings report, which they happened to release at the same time.
Okay, wait. How bad were the actual numbers? The standalone business?
Operationally, terrible. They missed badly on adjusted earnings per share, reported $0.43. Consensus was looking for something like $0.53 to 56 cents. Revenue was below estimates too. And most tellingly, they reported a staggering GAAP net loss of $265.8 million for the quarter.
Whoa. Where did that loss come from?
Primarily driven by a massive $289.7 million goodwill impairment charge.
Okay, let's pause there. Goodwill impairment. For listeners who aren't accountants, what does a huge charge like that actually signal about the company's health? It sounds bad.
It is bad. It's essentially management admitting past failures, big ones. See, when a company buys another, it often pays more than the target's assets are worth on paper. That excess price is recorded as goodwill, representing brand value, future synergies, market position, that kind of intangible stuff. If, down the road, that acquired business doesn't perform as hoped, the company has to write down the value of that goodwill. They impair it. So a charge of nearly $300 million. That's management basically saying, oops, those big acquisitions we made in the past, they're officially worth way less than we paid. It's a huge red flag about their M&A strategy and execution.
So just to recap, the company admits massive past mistakes, posts terrible current results, and the stock soars over 20%.
Exactly. Because the M&A valuation completely overrode the operational disaster. The price Invest Industrial is paying signals they see some strategic value in Treehouse, maybe restructuring potential, maybe brand value they can unlock that's significantly higher than the market thought the company was worth based on its current messy operations. For existing shareholders, those bad earnings became irrelevant the moment that $22.50 cash offer landed.
And the CVR. What's that?
The contingent value. Right. That just means shareholders might get an extra payout later if Treehouse hits certain specific operational or financial targets after the deal closes. It's a little sweetener, an extra bit of potential upside tied to future performance under new ownership.
Okay. Now let's look at the flip side of M&A excitement. The Sell a News event. Metsera, ticker MTSR. Shares are sinking today, down about 15%, even though Pfizer just agreed to buy them for a hefty $10 billion. Why would a $10 billion buyout make a stock drop?
Yeah, this is a textbook case of speculation premium just evaporating into thin air. The market knew Metzer was in play, that it was being shopped around. There were reports, pretty credible ones, that Novo Nordisk was also in the running, maybe even in a bidding war.
Ah, okay.
So the street had priced in the possibility of an even higher offer, right? Maybe $11 billion, maybe a protracted auction driving the price up further. Once Pfizer officially locked in the deal at $10 billion, a good price, but not a crazy bidding war price, all that speculative froth, that hope premium for an even better outcome, just vanished instantly. That 15% drop, that's the market removing the value of the what if. It's the certainty tax, you could call it. You lose the speculative upside once the deal is done.
All right, let's shift gears from M&A to pure, unadulterated fundamental terror. And this, I think, is maybe the most instructive, almost shocking case study this morning. Monday.com, ticker MNDY. We're seeing this stock get absolutely crushed, crashing down 15.27%, hitting new 52-week lows. Just brutal.
It is brutal. And frankly, it seems almost irrational if you just look at the headline results they reported, because the paradox deepens here. Their Q3 2025 results, they were actually quite strong. They beat estimates. Adjusted EPS came in at $1.16. Consensus was way down at Darrow paid 80 cents. Revenue was $316.9 million, also topping the $312.3 million estimate. By normal standards, a good quarter.
Okay, so they beat comfortably on earnings and revenue for the quarter that just ended. Why the absolute collapse? You mentioned guidance was the killer, but quantify that miss for us. How bad was it really?
The punishment is pinned entirely on their forecast for the next quarter, Q4. Management guided Q4 revenue to be between $328 million and $330 million. The analyst consensus expectation, it was $333.8 million.
Wait, so let me get this straight. They missed the midpoint of their guidance range versus the consensus by, what, about $4 or $5 million on revenue over $300 million.
That's right, a relatively small miss in dollar terms.
And for that, the company loses something like $2 billion in market cap today. Doesn't that make this whole growth stock valuation game seem ridiculously fragile? Or are traders just massively overreacting?
It feels like a massive overreaction, absolutely, but, and this is the painful part, it's sort of mathematically rational within the very specific, very demanding context of high-growth stock valuation. See, for a company like Monday.com trading at a really lofty premium, maybe 10, 15 times forward sales, not earnings past performance is almost, well, irrelevant isn't quite right, but it's heavily discounted.
Okay.
The entire valuation, that huge multiple, is predicated on expectations of future growth, specifically the steepness of the growth trajectory that analysts plug into their discounted cash flow or DCF models. So when management provides guidance that misses consensus, even by a seemingly small amount like this, the market interprets it not just as a small miss, but as a signal of a potentially severe deceleration in the rate of growth going forward. It suggests that the hypergrowth phase, the phase that justifies that sky-high valuation multiple, might be ending sooner than everyone expected.
Ah, I see. It changes the whole slope of the curve.
Exactly. And when you tweak that growth rate assumption downward, even slightly, in a DCF model for the near term, the compounded negative impact on the projected value 5 or 10 years out becomes enormous. It triggers this massive, punitive re-rating of the stock. And that's compounded by the nervousness about tech valuations that was already bubbling up last week. The valuation model demands near-perfect execution on future promises, and MNDY, in the market's eyes, just blinked. They didn't deliver the perfect future forecast. #, me on C.
Okay, so Monday.com shows us that toxic mix. Growth fears, hitting company-specific execution, or at least guidance issues. But let's contrast that punishment with the broad, sweeping relief rally we're seeing in the rest of the AI and semiconductor space. Names like NVIDIA, Palantir, they have no specific news today, but they're recovering aggressively. How do we square that?
This contrast is really the key to understanding today's weird market dynamic. While MNDY suffered what looks like a fundamental company-specific breakdown tied to its future outlook, the broader AI complex, the semi-stocks, they're experiencing a very different phenomenon. A macro-driven technical rebound. Remember, these were the names that got hammered hardest last week by those generalized lofty valuation fears. But those fears were largely external, right? Driven by the political uncertainty, the data vacuum concerns.
And the moves are significant. We're seeing Palantir, PLTR, up, 8.5%. That basically reverses its entire 11% loss from last week. Micron, MU, up 6.5%. NVIDIA, NVDA, up 5.5%. AMD, up 4.5%. It's a strong sector move.
And there's no specific company news for Palantir or NVIDIA today that justifies those big jumps. None. This is purely institutional capital flowing back in. It's momentum trading, maybe some short covering, unwinding last week's bets against the sector. The political optimism, the hope of a shutdown deal, it acts like an all-clear signal, however temporary. It allows capital that fled the perceived risk last week to rush back into what's still seen as the primary growth engine of the market, AI and related tech. The market is basically buying back the certainty, or at least the reduction in uncertainty, that it violently sold off just days ago. It's a technical unwind, plain and simple.
Okay, that technical rebound feels good if you own those names, but it pivots us directly to the really daunting reality that's going to define the rest of this week, navigating this data vacuum.
Right.
Because even if, let's say, a shutdown deal gets struck tonight or tomorrow, the fact that the government was closed for a record 41 days has created these profound consequences that just don't vanish overnight.
That's exactly right. The core problem is that the federal agencies, the BLS, the Census Bureau, they had to halt collecting, calculating, and releasing key economic reports for over 6 weeks. So we are now heading into a critical week with a completely broken economic calendar. Policymakers and investors were all forced into a degree of guesswork we haven't seen before.
And what are the specific big pieces of the puzzle that are missing, the reports that would normally be driving everything this week?
Well, the most critical ones, the ones the market and the Fed rely on heavily, are delayed. That includes the Consumer Price Index, CPI, for October. That's our main inflation gauge. It was originally scheduled for this Thursday, November 13th. Gone for now. We're also missing the Producer Price Index, PPI, for October, another inflation indicator, and the absolutely crucial retail sales report for October. Both of those were originally slated for Friday, November 14th, also delayed.
So no official read on inflation trends, no official read on the health of the U.S. consumer. The market is essentially blindfolded on the two most important factors right now.
Blindfolded is a good word for it.
Okay, so if the Federal Reserve keeps telling us repeatedly that they are data dependent, what does it actually mean for monetary policy when they're missing the core inflation and consumer health data? Can they even make decisions?
It means the Fed is, as one economist aptly put it, essentially flying blind.
Flying blind, yeah.
They're left sort of groping around in the dark, trying to steer this multi-trillion-dollar aircraft of the U.S. economy with maybe an altimeter, but no GPS, no forward-looking radar from the official stats. They've built their entire communication strategy around justifying rate decisions based on incoming data. Without official CPI, without official retail sales, it becomes incredibly difficult for the FOMC, the rate-setting committee, to credibly justify their next move, whether it's a hike, a pause, or even a cut eventually. It injects massive uncertainty into their next policy meeting because their whole justification framework has kind of collapsed, temporarily at least.
But surely they're using something, right? They can't just sit on their hands entirely. What alternatives are they, and by extension, smart investors, leaning on to try and fill this void?
Oh, absolutely. They're using alternatives. And this is where you, as an investor, really need to focus your attention this week. The Fed definitely has access to things like regional Fed reports, think the Beige Book, surveys from the New York Fed, the Atlanta Fed, plus high-frequency internal data, maybe even some private sector data they purchase. But the market, historically, treats the official federal data as the gold standard, the ultimate source of truth. So the absence of that official data massively magnifies the importance of all the secondary reports. Private surveys, regional reports, even anecdotal evidence from company earnings calls, they all get elevated. Investors are forced to use these as critical proxies. We saw that last week with the big reaction to the University of Michigan Consumer Sentiment Survey, right?
Right, that moved markets significantly. So is part of today's rally then not just relief about the shutdown ending politically, but also relief about the promise that the data itself will eventually return?
Exactly. That's a huge underlying component. The shutdown was crippling for markets precisely because of the uncertainty it created, political uncertainty and data uncertainty. The prospect of the government reopening means that eventually, hopefully soon, the data vacuum will end. We can get back to some semblance of fundamental data-driven analysis. Remember, the market hates uncertainty often more than it hates bad news. Getting the data back, even if it's bad, is preferable to flying completely blind.
Okay, now, we also need to flag a really crucial logistical quirk for tomorrow. Tuesday, it's Veterans Day, which means the U.S. bond market is closed, but the U.S. stock market is open. What kind of weird dynamics does that create for trading and liquidity?
Yeah, that's always a tricky setup. It generally creates thinner liquidity conditions in the stock market.
Yeah.
When the bond market is closed, a significant chunk of institutional players, especially those who rely heavily on treasury market liquidity for hedging or funding, might be less active or on the sidelines. This can often lead to exaggerated price movements in stocks on lower than usual volume. Any company-specific news or even the lighter economic data we do get can potentially have a bigger impact than it normally would because there's less overall market depth to absorb it.
So since we're missing the big dogs, CPI and retail sales, what becomes the most important data release we do get tomorrow, Tuesday?
The NFIB Small Business Optimism Index for October instantly gets promoted to critical status. It becomes a really key release. Analysts, and you should too, will be scrutinizing this index way more closely than usual, treating it as a vital proxy for underlying economic conditions at the ground level. And you'll want to look particularly closely at the subcomponents within the NFIB report. Things like the percentage of small businesses planning to raise prices that becomes a crucial proxy for inflation pressure when CPI is missing, and also their hiring intentions that gives us a timely window into labor market health before we get the official jobs data backlog cleared.
And midweek, we also have a pretty heavy slate of Fed officials speaking, don't we?
Yes, Wednesday is huge for Fed speak, absolutely critical this week. We've got a lineup including John Williams from the influential New York Fed, Governor Christopher Waller, Raphael Bostic from Atlanta, Susan Collins from Boston. A lot of key voices. Their commentary is going to be absolutely essential because they will inevitably be asked and will likely have to address how the central bank is navigating this unprecedented data blackout internally. Investors will be hanging on every syllable, trying to read between the lines, looking for clues about which private data sources or internal metrics the Fed is leaning on most heavily right now. What are they seeing that we aren't?
Okay. And then finally for the week, if the official retail sales report is delayed, potentially for weeks, what takes its place as the main check on consumer health?
The preliminary University of Michigan Consumer Sentiment Report. That is scheduled for release on Friday, and it hasn't been impacted by the shutdown, thankfully. Given the complete blackout on official retail sales data, that UMIC sentiment reading instantly becomes the single most important proxy for the entire week when it comes to judging the health, and maybe more importantly, the willingness of the U.S. consumer to actually spend money. It's a huge driver of GDP, so that report's significance just went way up.
This situation, this data vacuum, leads us directly to this fascinating inversion principle that's really going to govern the market for the next few days, maybe longer, which is corporate earnings reports aren't really being measured against the macro data backdrop anymore. Instead, the market is being forced to use corporate guidance and commentary as the de facto macro data itself. So this relatively light earnings week suddenly becomes incredibly significant, doesn't it?
That inversion is profound, and it's critical for listeners to grasp. Normally, right, you'd take Disney's results, compare them against the official retail sales data, and say, okay, how does Disney's performance stack up against the overall consumer spending trend? But this week, there is no official retail sales data to compare against.
Right.
So the market has to take Disney's management commentary about park attendance, about streaming subscription trends, about per capita spending in the parks, and treat that as if it were the official report on consumer discretionary health. Every single corporate guidance figure, every bit of management color on the earnings calls this week, it gets elevated. It becomes a forced macro indicator, whether the company likes it or not.
Okay, let's zero in on today's crucial reports coming after market close, AMC. We've got Occidental Petroleum, OXY. Beyond the headline EPS and revenue, what specific insights will analysts be digging for there?
Yeah, Occidental is expected to report a pretty significant year-over-year decline in earnings and revenue. The Zacks consensus estimate for EPS is around $0.48, which would be like a 52% drop from the same quarter last year, mostly due to lower oil prices compared to then. But the focus won't just be on that backward-looking decline. Analysts will be laser-focused on operational clarity. Specifically, production volumes coming out of the crucial Permian Basin, are they hitting their targets? And maybe even more importantly, commentary on their aggressive debt reduction strategy. How is that actually flowing through to lower annual interest expenses? Because that's absolutely key to unlocking their future free cash flow potential, which is what equity investors care about.
But the report that feels like it holds the key to whether today's big tech and AI rally has legs, that's arguably CoreWeave, CRWV, also reporting after the close today. This feels like the AI proxy right now.
I think you're right. CoreWeave is probably the single most critical report of the day, maybe the week, for tech sentiment, because the market is just desperate for some kind of validation after last week's sharp AI sector sell-off. CoreWeave, as you know, is a key player in the AI data center space. They essentially rent out massive amounts of high-powered GPU capacity and related infrastructure that companies need to train and run AI models. So their results give us arguably the most direct, real-time read available on actual AI-related revenue generation, and critically, the underlying demand for AI infrastructure. So specifically, what will investors be looking for? I think two main things. First, their capacity utilization rates. Are those hugely expensive clusters of GPUs they've built running at full steam? Or is there some slack appearing? And second, maybe even more important for the forward look, their capital expenditure plans, their CapEx guidance. Are they still planning to spend aggressively, maybe even accelerating spending, to build out more capacity to meet anticipated future AI demand? A strong report from CoreWeave, especially one signaling aggressive forward spending, could really solidify today's tech rebound. It would suggest the AI build-out is still full speed ahead. But a weak report, or guidance that suggests maybe a pause or slowdown in their infrastructure build-out, that could instantly reignite all those AI bubble fears we saw flare up last week. It's a pivotal report for sentiment.
Okay, looking just a bit further ahead mid-weeks, let's quickly flag the other key corporate reports acting as proxies for the broader economy. Wednesday after close, we get Cisco Systems, CSEO.
Right. Cisco is always treated by the market as a sort of foundational proxy for enterprise spending. Overall corporate IT budgets, network demand across pretty much every industry. If Cisco's management lowers their forward guidance, especially if they talk about a slowing backlog for hardware orders, that's a major signal. It suggests CEOs globally are starting to pull back on big, multi-year technology investments and infrastructure upgrades. That would be a significant economic warning sign, effectively replacing the missing official government reports on business investment.
And then on Thursday, we get the Walt Disney Company, DIS, reporting before the market opens.
Disney essentially serves as the market's #1 proxy right now for consumer discretionary health, especially with no retail sales data. The devil will absolutely be in the details of their operational segments. Forget just the headline streaming subscriber number that's become a volume game with questionable profitability sometimes. The market will look deeper. Park attendance figures, yes, but crucially, the per capita spending within the parks. Are people still dropping big bucks on tickets, food, merchandise? If that per cap spending is strong, it suggests the middle-class consumer, despite inflation pressures, is still healthy and willing to splurge on experiences. That provides a really crucial real-world data point, offsetting the lack of official government stats.
And also on Thursday, but after the close, we have Applied Materials, AMAT.
AMAT. This one's critical as a direct proxy for semiconductor and AI capital expenditure spending. They make the incredibly complex, expensive machines that companies like TSMC, Intel, Samsung use to actually manufacture advanced computer chips. So AMAT's forward-looking orders, their book-to-bill ratio, their guidance that's effectively a forecast for the entire semiconductor manufacturing cycle, looking maybe 2 or 3 quarters ahead.
Got it.
If Applied Materials reports a weak outlook or talks about customers delaying orders for new equipment, it's a massive signal. It suggests the entire chip industry, including the customers of NVIDIA, AMD, everyone might be slowing down their long-term plans for building new factories or upgrading existing ones. They really are the ultimate canary in the chip industry's coal mine. What they see often predicts where the whole sector is headed.
And just one quick technical detail for investors to keep in mind today, Monday. Several fairly large, notable companies are trading ex-dividend. That means if you buy the stock today, you don't get the upcoming dividend payment. This will have a small, purely mechanical downward impact on their share price today. Examples include Apple going ex-dividend to 26 cents per share, American Electric Power, AEP, at $7.95 per share, and Aztec Industries, ASTE, at $7.13 per share. Just small adjustments, but always worth noting on a day with sensitive technical trading.
Good point. Those little adjustments can sometimes confuse the picture if you're not aware of them. #tag outro.
So as we wrap up this deep dive, we're left with this really powerful, almost jarring contradiction, aren't we? At the macro level, you've got this genuine market euphoria, this violent technical rally, all driven by the hope of a political solution finally ending the shutdown mess. That's clearly unwinding last week's generalized fear. But then you zoom into the micro level and you see this extreme, almost surgical scrutiny being applied, exemplified perfectly by Monday.com getting just savagely punished for a fractional miss on future guidance. It shows that underlying expectations for growth remain utterly, brutally unforgiving.
That synthesis is absolutely the most important takeaway from today, I think. Monday's big move higher. It's fundamentally a political and technical event. It's unwinding fear. It's unwinding speculation premium. It's relief, pure and simple. But the rest of the week, that's the real grinding test, the fundamental test. The big question now is whether these corporate proxies we've been talking about, CoreWeave tonight on AI demand, Disney later on consumer health, Cisco on enterprise spending, AMAT on semi-capex, can they actually provide enough positive news and a fundamental justification to sustain this newfound optimism, especially when the Fed is still flying blind and we have this complete void of official economic data? That's a tall order.
So what does the setup mean for the bigger picture view of this rally? Is it sustainable or just a temporary sugar high?
Well, the market is clearly celebrating the end of uncertainty, or at least the perceived end of the political uncertainty. And that reduction in uncertainty is always a powerful short-term propellant for asset prices. Never underestimate relief. But, and this is the big but, in doing so, the market might be dangerously overlooking the very real economic damage that might have already been inflicted by this record-long shutdown. We already saw hints of that damage last week, didn't we? In that shocking crash in the University of Michigan Consumer Sentiment Survey, in some of those concerning private sector layoff reports that started trickling out. So the crucial question I think you, the listener, need to really grapple with is this. What happens when the official data that's been delayed, the October CPI report, the October retail sales numbers, what happens when that data is finally released, maybe in a week or two? What if it reveals the true, maybe ugly economic cost of this 41-day shutdown? Could that delayed data bomb lead to a major fundamental risk-off shock that completely reverses today's purely technical optimism, that potential mismatch between current relief and future reality? That's the storm potentially waiting just over the horizon. It's precisely why certainty, even if it proves temporary, feels so incredibly good to the market right now.